So whenever yearly yield is coming, suppose say in 10-year GSEC you are getting 6% yield. Okay, so whether this will be considered as daily yield, whether it daily 6% or this 6% is per annum. All of you are able to hear me? Whenever we say
Yes, can you repeat the question?
The question is, whenever we say 10-year GSEC yield is 6%. Okay, so is it yearly or is it daily? Let us see the 10-year GSEC yield. Suppose say because it's 5.8% or 6.18%. So you can say 6%. If we, on an average it is 6%. That 6% is your yearly yield or your this is the yield for each of the government instruments or financial instruments. So you are getting 6.6 or 6.30 or 6.21. So this 6.21 is yearly yield or daily yield or monthly yield. That is what my question is.
Yearly.
Okay, it's yearly yield. Now how we'll use that for daily? We have daily share prices. So yearly for say 252 trading days, or you can take someone takes 365, but 365 trading days are not there. 252 to 54 trading days are there. So for 252 you are getting 6%. For one day, how much you will get? For 252 you are getting 66%. For one day, for 252 days you are getting 6%. For one day, how much you will get?
66 by 252.
Yes, 66 by
252.
So you will calculate how much is coming is the daily yield. That we consider as risk-free return. Why this risk-free return is more important in portfolio? Always in, if you see in Marquis also we have spoken about risk-free return. What is the use of this risk-free return in case of portfolio? Why we are more focusing on this risk-free return? Anyone?
It helps us to understand whether how our portfolios are performing, like whether our investments are giving us like high returns.
Sorry, understand?
It helps us to understand how our portfolios are performing, whether how much return it's giving, like whether it's giving returns more than the normal return currently in the market, return currently in the market, or it is giving less than that, so that we can invest accordingly.
Yes. The basic idea is, without taking any risk, I am getting 6% return per annum. So whether I will get, if I am taking positions or I am investing in the risky assets, relatively risky than the government securities, then whether I am earning higher than the risk-free return or lower than the risk-free return. If it is lower than, then I will not go for these assets, those risky assets. I will go for only government securities, because there I am getting 6% return. Why should I come to this GSEC or this risky securities? So the main objective of the risk-free return to include in the portfolio is to come out with one aspect that will help us, whether the asset class that we are going to invest will give us a higher return than the risk-free return or not. Because in risk-free return, we are not taking any risk, and we are getting a return of some fixed amount of return. So if I am going to any of the risky assets, I should get higher than that. That's why always risk-free return is considered. So this CAPM is equilibrium between risk and required rate of return or expected return, and well diversified portfolio. So it is based on the premise that only one factor affects risk. What is that factor? What do you mean by factor? Anyone has heard about this factor? So when we say RP or RI equals to RF plus beta into RM minus RF, we are considering this risk premium. This is called as risk premium. RM minus RF is risk premium. Okay. Why this is risk premium? Because we are getting higher return than the how much excess return we are getting by deducting from risk-free return or as compared to risk-free return. Then this beta is one factor. So the coefficient for one factor, we are creating one factor that is called risk premium, and beta is the coefficient for that one factor. What do you mean by factor? That means which are the factors that are affecting to my return. Now I am considering the risk premium as the factor. If we go on to Pharma French model, we will add other factors other than this risk premium, like market capitalization, book value. We'll go for that. So what we are getting over here is this is simply a regression. Yes or no? You can say this is simply a regression. RF plus beta into RM minus RF. So you just do RM minus RF, you will get one series and regress with the RI if you are considering RF or simply alpha. So you will come out with a beta value that is nothing but the regression coefficient or the slope of the regression. I hope all of you have done regression in your data analytics or econometrics. Yes or no?
Yes,
Yes,
sir.
sir.
So this is simply a regression that we are going to do. Now, whenever we come up with any of the theory, they have certain assumptions or they have certain characteristics that we need to fulfill that, or we need to consider that before applying that CAPM model. Although there are some shortcomings of this CAPM model, just like shortcomings of Marquis mean variance model, again, there are no alternative model to this CAPM model. So first is investors make their investment decision based on risk return assessments measured through in terms of expected return and standard deviation of return. And buy and sell of security can be undertaken infinitely, and buy and sell by a single investor cannot affect the price as there is perfect competition. This is perfect competition in the market, and investors have same amount of expectation or same amount of expected return and risk in a identical holding period or identical expectation regarding the expected return, variance of return, and covariance of all pairs of securities. So when we say variance of return, that is the risk part we are considering. When we say expected return part we are considering. When we say covariance of all pairs, what do you mean by covariance? What do you mean by covariance? Anyone? What is variance and what is covariance?
So variance is that how much a variable varies from its mean, and covariance is like when how much the two variables varies together. It measures that.
Yes. So it is between two variables how much they vary together. So this covariance helps us to identify whether they are behaving in a same manner or they are in a opposite manner. Then another thing is there are no transaction costs. We have seen in in the trading and investment we bear some transaction cost. Here it is assumed that there are no transaction costs because the transaction costs are very small, and there are no personal taxes. Okay, even tax on dividend income and capital gain are same, and the investor can lend and borrow any amount of funds they desire at a rate of interest equal to the rate of riskless securities or risk-free securities. Riskless means risk-free securities. The investor can sell short any amount of any share. What is this short? What is short? What is short and long in the market? Quickly.
So short means selling and long means buying. Right?
Long means buy, short means sell. Okay.
Sell.
Yeah. And investors share homogeneity of expectation. All investors are having uh, similar kind of expectation or same expectation because we call it as market is efficient. When we say market is efficient, we say all the investors are having equal number of say information. No investors is having a superior or inferior information, so that one will come out with abnormal profit and another will come out with huge losses. So a market is efficient, that means all are having same amount of information. So why does this RF on the efficient frontier? We have just discussed like what is the role of this risk return. So we have seen the tangency point in the efficient frontier also. What does that efficient frontier tells us? What does this efficient frontier tells us?
So multiple sets of risks and returns that we have.
Come again.
So the combination of multiple risks and returns we have, so
Yes.
basically it captures that.
So it carries all the return and risk. So return and risk of all the combinations, so that it gives us a good amount of portfolio diversification, so that we will come out with a good efficient frontier that represents the relationship between risk and return. Now we have also learned how we can draw one indifference curve and come out with a, what is that? We come out with a, what we come out with through indifference curve. To remember, we have done this during a mean variance approach.
So the optimal portfolio.
Yes. So our point is to identify the optimal portfolio and a efficient portfolio. So what is this efficient portfolio and optimal portfolio? The optimal portfolio will say you are taking minimum risk and maximum return. The efficient will also say you are taking higher than the optimal portfolio risk and you are getting maximum return. So if you come down, this is called capital market line. What does this capital market line tells us? You have heard about capital market line and securities market line. Have you heard about this CML
No,
and
sir. No, sir, I
yes?
haven't.
Yes, Saranya?
No, sir, I haven't heard.
Okay. So we'll discuss about this capital market line and securities market line. But so far we know that this is one independent curve that helps us to find out optimal portfolio or efficient portfolio. Okay. Now what this capital market line is, all linear combination of the risk-free assets and portfolio of market return, and portfolio below the CML are inferior, and CML, that is capital market line, defines the new efficient set. All investor will choose a portfolio on the CML. Okay. So it will give them a new efficient set. How do we get this CML? It's just risk-free rate of return, expected market return, and the risk-free rate of return upon your standard deviation. That is the slope. Then standard deviation of the portfolio, that is the risk measure. Then we'll come out with a CML or capital market line. In place of standard deviation, if you are getting beta, then that is called a securities market return. So what is difference between systematic risk and unsystematic risk? We have two risks. One risk is measured through beta, another risk is measured through standard deviation. Whether systematic risk is measured through beta or unsystematic risk is measured through beta.
So systematic risk.
Is it correct?
Sir, unsystematic risk is measured through data.
What is difference between these two risks? Can anyone say?
So systematic risk is basically that global that has affected the whole of the economy, like all the firms and all the and unsystematic risk is that has happened to a particular firm due to some internal reasons, and it has affected that firm only. And
Can we reduce the systematic risk? Can we avoid systematic risk?
no, systematic risk cannot be like changed or anything. Like it is already expected that it will
What
happen.
about unsystematic risk?
Unsystematic risk can be controlled by taking various measures. By
What are examples?
investing in various forms. Like we can make a portfolio by investing in different um,
Okay.
different shares.
What are the differences? Means which are the examples of systematic risk? Can you say? Which are the risks that comes under systematic risk? And which are the examples of risk that comes under unsystematic risk?
So unsystematic risk is basically suppose when there is some kind of problem within the firm, like maybe uh, the workers are revolting and demanding some money and so extra wages, so they stop working and thereby the firm starts to fall. But systematic risk is like when the whole economy gets affected, like suppose there is a change in the government policies or government imposes some new rules, so that affects the whole economy, or sudden pandemic like this COVID-19 pandemic, which had affected the whole economy.
Okay. Anyone can give a good. Saranya has given good example. Anyone can give any extra example other than Saranya?
So for systematic risk, we can say the financial crisis that happened. So these kind of events really affect.
Yes. Then
For systematic risk, we can have inflation rate risk, interest rate risk. And
yes.
for unsystematic risk, we have financial and operational problems occurring within a company.
Yes. Business risk, financial risk, those are coming under unsystematic risk. Now the question is which is whether Beta is calculating systematic risk or beta is calculating unsystematic risk? Yes, anyone?
Sir, I think beta is calculating unsystematic risk.
Standard deviation?
Yes, sir.
Standard deviation?
Standard deviation calculates the systematic risk.
Are you sure?
I'm not quite sure.
Mansimaran, Rasi, which is calculating what?
Sorry, sir, but I think I believe the opposite ways of Sharon. Yeah. I'm not sure.
You believe?
The opposite of what Sharon mentioned, that beta
Yes,
captures
yes,
the
yes.
systematic risk.
So beta measures the systematic risk, standard deviation measures unsystematic risk. Okay. So whenever we use beta, we'll come out with securities market line or SML. Whenever we come out with the standard deviation, we'll come out with capital market line or CML. So the expected return on any efficient portfolio is equal to the risk-free rate plus some risk premium or some extra return that we get over and above the risk-free rate. So the optimal portfolio for any investor in the point of tangency between the CML and the investor, say indifference curves, is the optimal portfolio, or we call it as efficient portfolio. So in efficient frontier or through Marquis model, we are getting this is our efficient portfolio, but through capital asset pricing model, we are getting this is it gives more return as compared to that other one. So in other one also, whenever we are coming out with we are taking the same amount of extra risk with same amount of extra return. So investor can choose whether they will at the R point or M point. So they can select, and both those things they will get benefit, but this will give more benefit because this gives R point gives, or the optimal portfolio point gives, helps to get maximum return with minimum risk. That's why it gives the risk return relationship for the efficient frontier. That's how it is CML. And the SML also gives risk return relationship, but that is to individual stocks. So SML is RF plus return of portfolio of market and into beta. So you can say RF plus beta into RM minus RF that we are getting. So if we divide that into beta, then we will come out with the securities market line. Then simply we run one regression and get the slope or beta coefficient, and that line itself will tell us whether it is efficient or not. So whenever you say beta of market or beta of a say single security and you just plot it, you will come out with a slope. Anyone has asked any question? Okay, so you will come out with a slope. Now, how we can compute this CML and SML? You can all of you have measured this beta. If beta is 1, then what does it mean? If beta is 1, then what it represents?
Sir, if beta is 1, it represents that it's equal, the risk-free rate of return is equal to that portfolio rate of return.
Okay. So that means our portfolio or our stock will move in a same direction as market moves, or but if we, that means we call it as average risk. If the market is having this much risk, then our security or our portfolio will have the same amount of risk. And if it is beta is greater than 1, our stock is riskier than the market. Okay. If beta is less than 1, then it is less risky. And normally beta moves 0.5 to 0.15. So what is difference between this SML and CML? The SML is securities market line and CML is capital market line. So in SML, risk is identified as systematic risk, and in CML, it is the total risk and measured by standard deviation. Then SML is valid for portfolio and individual securities, but CML is only for efficient portfolio. SML is based on CAPM. CML is also based on capital theory, that is little higher than the CAPM model. So now we'll come out with doing this CML, SML and doing this CAPM model through R. Then we'll come out and discuss the market model and uh, other parts in the portfolio theory. So market model and pharma friends model. Now you just open your R file that I have sent to you. Open your R file. All of you have opened?
Just a moment, sir, please.
Yes?
Sir, just please wait for a minute, please.
You're not audible properly. Mansimran? Gaurav?
So I'm good to go.
All of you have opened your R file?
Yes, sir.
Okay. So the first part is we will build one portfolio return. So we need to get the individual return, then we'll get the portfolio return, or we call it as hypothetical portfolio return. Okay. So if I am coming out with first you use Amazon data. So I hope all of you have downloaded data and kept in your work directory. All of you have done that?
So give me 1 minute.
Okay. So download all the data and keep it in one folder, so that whatever data we required, we can extract from that directory, and set your working directory as that folder only. You can write down in the chat box those who have already downloaded all the data sets and file and opened the R file. Just write down in the chat box that you have done. Saranya downloading, Rajaditya done, Gaurav done. What about others? Mansimran, Rasi, Mansi, Sribardhini, you have downloaded? Okay. Okay. Gaurav done. Okay. Saranya will proceed.
Yes, sir. Done.
Okay. Now just say you set your work directory and import data for Amazon. Then we need to get Amazon the Amazon return. For that only from the adjusted price of Amazon we'll get the Amazon return. Now again we need to convert that daily data into monthly data using 2.monthly. Okay, and that Amazon dot return is there in the 6th column, so you can say Amazon monthly is there. 6th, then we use delt. You need it two libraries. One is quant mode. TTR is optional, you can or you may not, but quant mode is compulsory for the financial theories, and for calculating the return also we use that quant mode. One is delt is one of the command under the quant mode. We have also done previously daily return, weekly return, monthly return command. That was also coming under quant mode. So we need to get return of that adjusted closing price of Amazon. What is difference between closing price and adjusted closing price? What it adjusts, why it is adjusted closing price? Anyone?
So I guess adjusted closing price is the average of the last 30 minutes price. So that, for example, if we have a close price, which may not depict that last 30-minute closing price, maybe due to some reason, the price may decrease, or the last price may decrease or increase. So in order to depict the last 30 minutes price, we used to take adjusted price.
No, that is not adjusted. That is closing only. That is
Okay.
the closing price of last half an hour adjusted.
Okay, sir.
That is not adjusted. It is a weighted average price. But the adjusted price adjusts something else. Adjusted price adjusts with the corporate actions. All those stock splits, dividend announcements, or say bonus issues, all those corporate actions will be adjusted through the adjusted closing price, but that will not be adjusted in the closing price. That's why it is more meaningful to always consider the adjusted closing price instead of closing price. Now you can get the return of this Amazon. That is the adjusted closing price only. Adjusted closing price of the Amazon. We have named that Amazon return. Now, just like that, you can calculate the Yahoo return. So import the Yahoo data and convert it into date format, and cbind with date and data Yahoo. Then you get the orderly Yahoo and convert it into XTS, that is time series. Then you can name the columns and convert that daily price into monthly price through 2.monthly, and just see the rows, number of rows, and get the only one, that is the adjusted closing price, and adjusted closing price return calculate. through using tilt, and name that return of that adjusted closing price as Yahoo return. Okay, and you can see the three say uh, three rows, and one row is NA, because in whenever we calculate return we left out with one the top row, because the previous data is required, but for top row previous data will be not available. Now you come out with the IBM return, calculate IBM return now in the same manner. So you can get the IBM return. Once you get this IBM return, now you combine through cbind your Amazon return, Yahoo return, and IBM return. That will be called as your portfolio or portfolio return. Okay. Whenever you combine that, you see how does it looks like. You are coming out with NA in first row, and just see the number of row. Now just remove that NA and come out with the portfolio return, and combinedly portfolio return of all. So if you combine that, come out with portfolio return, then we name that portfolio return as hybrid hypothetical portfolio return. So you can say uh, you can say date and the portfolio return, and row names you can give names of Jan, Feb, all those months. Then you just write that CSV to your folder as hypothetical return monthly. You can say hypothetical portfolio new. Okay, so new hypothetical portfolio. You just write down here new, because already hypothetical portfolio is there in your folder. So you just go back to your folder, and you will get the hypothetical new data, hypothetical portfolio new data file you are getting. All of you got this in your folder, hypothetical portfolio new? Yes or no?
Yes, sir.
Okay. So we'll use that hypothetical portfolio for our further analysis. Now we got the portfolio return. So portfolio return is the combination of, suppose, say, three securities that we have. We are using that portfolio return. You can say this is new. Now you import that portfolio return. We have exported that portfolio return to our folder. Directly you can use it just to save that portfolio return. You just export it. Now you import that portfolio return. We want this CAPM model to build up, and come out with seeing how this portfolio return looks like, and see class of portfolio return. Then you come out with the date and class of date, then the portfolio with date, and one X is added. Now you are getting the portfolio returns. What we need to do is, we need, one is portfolio return, second one is in a CAPM model, what are other things we need? One is RP, or return of portfolio, equals to RF plus beta into RM minus RF. Yes or no? So for RF we need one risk-free rate, and we got this RP, or return of the portfolio. We got it, return of the portfolio. Now we need one RM to represent market return, and we need one RF to represent risk-free return. Okay, market return and RF is risk-free return. Okay, risk-free return. Now, what we need to do is you can use S&P 500 as market return. Whenever we say market return, we represent one index to get the market return. When we say index, that represents the maximum market capitalization of the country. So we call it as market return. For India, say you can consider Sensex or Nifty as market return. For other countries like USA, either you can consider S&P 500 or Dow Jones. So you take this S&P 500. The data is GSPC. The Yahoo Finance code is GSPC. That is how GSPC data is with you. Now import that data. Now the same way you calculate the market return, the way we have calculated the return of securities, and convert that data into monthly data so that we'll come out with monthly analysis. So you can get this market return. The market return is with us. Now what extra thing we need? We need risk-free return. Yes or no? We need risk-free return. So for risk-free return, you get this 3 months, say money market return, 3 months, say treasury bill yield. Then you just read that this CSB, DGS 3 month one. So you get that data, and again, yes. So again, you can get that rate and get the two monthly. That means you convert it into monthly, then convert opening annualized yield. So this is annually you are getting this 13% or 11% yield. Now you just convert it into that means if it is monthly, then 12 month. So for 1 month, sorry, for 12 month you are getting, say, what is the getting, say, 11% or 14%. Now how much you will get for for 1 month? You get the monthly risk-free return. Now we got the you just subset data from January to till date, January 2011 to December 2013. Now you combine farm market and risk-free data so that you can use it for CAPM model. Okay, so you can use it for CAPM model, and now we have portfolio return, risk-free return, and market return. 3 columns we have, or 3 data sets we have. Now you can calculate the excess return. What is this excess return? Excess return of farm and excess return of say market, or excess return of portfolio and excess return of market. How do we get? How do we get excess return? What do you mean by excess return? Yes, quickly. I hope I am audible. Am I audible? Rasi? Mansi?
Yes, sir, you are audible.
Yes. So what is excess return? Srivardhini? Have you come across?
The returns that we are getting beyond the risk-free returns.
Yes.
Returns that we are getting over and above risk-free returns.
Yes. So whatever extra return we are getting over and above risk-free return is the excess return. So we just deduct our portfolio return from the risk-free return. So we will come out with the excess return. So excess return for say farm or the portfolio and excess return for the market. Then you can see what is the excess return we are getting. Then we can use that for the regression. So in the Kaplan regression, what it is saying, so we say excess return or the return of that portfolio is a function of excess of market, or that is risk premium. Okay, so that risk premium is RM minus RF. Now you just simply run the regression. You'll get the regression result. All of you got the regression result. All of you got the regression result. What is this beta value? How much we get? How much beta value you got? You can write down in the chat box whatever beta value you got, or the coefficient value you got. Okay, what is the beta value you got? All of you have run through till now.
No, sir, I got the error in between, so I'm unable to generate any results.
What error you are getting?
Sir, I guess there is some problem with the file, like I don't have the yahoo.csv file.
Yahoo data is not with you.
No, sir. I'm not sure if everybody else has got it, but it was not there in my direct file.
No, sir, I also haven't got that. Like, it was also showing error in my case. I thought I have missed something, so that's
Yahoo
why.
data I have not sent to you. Only Amazon. Okay. Okay, let me send it again. Okay. Just give me a moment. You should tell me that you are getting that error.
So there is this another file,
Yes.
GTSC, that is also missing.
Yes.
Sir, we have used another file, .csv, that is also missing.
Yeah. I missed to send you all data, only Amazon data. I'll send all data. IBM and Yahoo. I'm sending you all data. All data are not required now, but maybe later on we'll use it. So you can save it in same folder. I'm just sending. It's taking little time to upload. Just wait. You got it? Delete. You got it? Just check. Saranya?
Sir, I haven't received it. I think you'll have to send it separately.
Sorry?
I haven't received the files. You'll have to send me those separately.
Yeah, I have entered your email ID over here.
Sir, I also haven't received it yet.
Okay, just. Yes, check. It has gone now. Just download those files. You can take 5 minutes break. You can download and keep on that. So 10:53 will start at 10:58. Okay. 10:58. Just
Sir, I'm
download
not
those
sure.
files.
I haven't received it yet. Did others get it?
So
No.
even I
No,
haven't
no,
received it.
they haven't.
I'm not getting what you are saying.
So we haven't
Sir, we
received the
haven't
file
received
yet.
the files.
Just check. Now it is gone. Check whether you have received them.
Yes, sir, got it.
Yeah. So we'll take 5 minutes break. Just I have to get some calls. So in 5 minutes we'll rejoin. Means be logged in. Okay. So we can start. all of you have run through those returns and got the total hypothetical portfolio return as well as return of risk-free rate and market.
I'm sorry, sir, but I'm still getting error. I'm getting another error this time.
What is the error? Can you show me? I hope you have kept all that
Well-
data in same folder that you have set to work directory.
Yes, sir. Yes, sir. It is about the. There is some function we have used DELT, so it is around that.
And then you have to install your quant mode. I hope quant mode is not installed properly, or you have not installed.
Okay. Okay. Thank you, sir.
First install quant mode. Srivardhini, you are getting?
Yes, sir, I'm doing it.
Okay. Saranya, what about you?
So actually my R closed all of a sudden. I'm reopening it. Like it's facing some problems, but I'm doing it.
Okay. Mansi, Mansi, you are there, Mansi? No. Mansimran,
Yes, sir, doing.
Gaurav,
Sir, doing. Some little time required.
okay. Manvi,
Yes, sir, working on it.
Gaurav, that is Gaurav, that is. You are there? Mansi single, Gaurav, that is. Both of you are not responding.
So can I just show my error? I'm getting another error of .xts. I've installed, but it's there, it's loaded, and yet it is showing.
Can you share your screen, Rasi?
Yes, sir. Yes, sir.
Share your screen, we'll see.
Sir, is it visible?
Yes, it's coming. Yes. Have you installed that quant mode?
Yes, sir. It is there.
Just open run that library quant mode.
Yes, sir.
And library TTR also, try for TTR.
Both are loaded, sir.
Okay, then yeah, then run through.
So it is showing the error about this XTS.
Okay, go off. Go off. Library XTS is there, no?
Yes, sir.
Yes.
I loaded that as well.
Just run through. Okay, that is also there. Now it's
Again,
coming.
okay. No, sir. Again, the same error.
Anyone is getting this XTS error? Can you go up, Rasi? Again, go up.
Sorry, sir.
Go up. Go to the top. Okay. In the packages, just write down XTS whether it is there in this
Yes, sir, it
right
is.
hand side. Just check XTS is there. Yes, it is there.
Yes, sir, it is
And
there.
check.
Yes, sir, it is there.
Yeah, it is there. It should not create problem. So run through from the beginning now. From setting your work directory.
I think it works, sir.
Yeah. So it was just that
Thank you,
package.
sir.
Welcome. So once all of you are with a Kappa model regression, that regression result you got, then you write down in the chat box that you got that regression result. So once you are with the regression result of Kappa model, just write down in the chat box that you got the result, or simply write down the Srivardhini, it is working.
Yes, sir, it is, but my laptop is taking a lot of time. Something's wrong with it.
Okay. Only Rasi has done. What about others? Done? Have you done it? Gaurav? Okay, Gaurav done. Gaurav Kadam done. Gaurav Dathet done. Write down your beta value over here. Those who have done. Rasi, Gaurav Kadam, Gaurav Dathet. Write down your beta value in the chat box. How much beta you got? Gaurav Dathet, write down. Okay, 0.761. Gaurav, that is 761. What about Kadam? Okay. Srivardhini, you have completed?
No, sir, I haven't. My laptop is, I don't know, something's wrong with it. It's just too slow at the moment. I'll do it, sir. I'll complete it today. Sir.
Okay. Saranya? Okay. Let me introduce another model called, let us see. Market model. We'll complete that market model. So kappa beta value you are getting, then like 0.761, and the p value for that beta is significant. That means, what does it mean? If beta value is 0.6761, what does it mean? How you can use it? Can anyone tell? Now in the kappa beta we are getting 0.761. Yes. Anyone? So in the, okay, I have not shared my screen. Saranya done. How much beta value you got, Saranya? Okay, 0.761. Good. So what I am saying is, whenever we come out with this beta is 761, what does it mean? Suppose say Rp equals to Rf plus beta Rm minus Rf. Now this beta we got is 0.761. What does it mean? And what is this factor? This factor is called as risk premium. Yes or no? Now, how do you interpret this beta result? You have seen like beta is 1 means it is high risk, riskier than average, riskier than average. Now, how do you interpret this?
So here beta is less than 1, so the stock is less riskier.
Less risky. Okay. So it is less risky. That means if market will move by 1, then stock will move by 0.76 or our portfolio will move by 0.76. Let us see other way. If we are not considering this RM minus RF, if we will simply say RP or market is determining our rate of return or impacting to our rate of return, not the risk premium. So when we add risk premium, that market model, what we are saying, return of the market only impacts to the return of the portfolio, or it's not the risk premium. So when we say that, we are considering the market model. When we consider risk premium, we are considering the CAPM model. Clear? What market model is? All of you are getting what market model is?
Sorry, sir, but could you please repeat? I lost you in between. I'm sorry.
Yeah. So what we are saying, I just missed the market model slide. Okay. What we are saying, in CAPM model, the CAPM model formula is RP equals to RF plus beta into RM minus RF. Okay. Then what we are getting over here is, this was risk premium. Yes or no? Risk premium. We are regressing risk premium with the return of the portfolio. Now, in the market model, we will say we will not consider this RF. What market model will say, RP equals to alpha or your constant plus slope into RM. That means it is saying only return of the market will impact to the return of the portfolio. That's why this is called as market model. Why it is market model? Since market is determining my portfolio return, or market is determining my portfolio return or my securities return, and this is called as CAPM model. Are you getting the difference between these two models? One is CAPM, another is market model. In market model, we don't adjust with risk-free return. Only we say market only determines the return, and here we say the risk-free return or the risk premium determines the return. That is the only difference between CAPM and market model, or else everything is same. Now we'll check in the market model what is the beta we are getting. So now we can check what is the beta we are getting in the market model. You come down and take this run this regression, where only market return is your independent variable, then your portfolio return is your dependent variable. And all of you know, I hope you have run regression in the R previously. Yes or no? Yes or no? Have you run?
Yes, sir.
Yes, sir.
So you know this del and uh, this lm is the for lm is the function for regression. So you do you take the portfolio return is your dependent variable and market return is your independent variable. What is the regression result that you are getting, and how much is your slope you are or beta you are getting? Beta is 0.761. So just try this. I'll urgent call is there. I'll just try this. Yes. So all of you got that result of market model, the beta of market model. So if we just do adjusted beta of 1 upon 3 multiplied by 1, then we'll get out, we'll get the 8.841. But what we are getting in the market model is same as we are getting in the CAPM model. Yes or no? Yes or no?
Yes, sir.
So what is the difference then? The difference depends on the how much risk-free return we are getting. Okay, if we are getting higher risk-free return, this beta will fluctuate, or else if risk-free return is very negligible, then this beta will be same as market model, and CAPM model beta will be same. If you remember in the event study, what model we are using in the event study? Whether we are using CAPM model or we are using market model. In the event study, all of you have done that, right? Then you will get one assignment on event study. Saranya, have you done the event study?
Sir, actually I was absent the last class, but I will watch the recording.
Please watch that. Please watch. And Rasi, Gaurav, Mansimaran. Srivardhani, have you done any time event study?
No, sir, I haven't.
Just check that with all the files you get it from anyone.
Yes, sir.
Saranya or
Yes, sir, I'll get all the files from the office today. And
just check with this Srikanji to give you all the recordings, or else you contact me. Okay.
yes, sir.
Okay. So in the event study, we are using this market model only. Okay. We are using market model. You can use CAPM model as well in event study, because in event study our objective was to get the alpha value and beta value. So either you get alpha beta value from here, from the CAPM model, or you get from the market model. So only one addition in the CAPM model is the risk-free rate of return, or RF. Okay, all of you are getting? So in what we are doing in event study, first we are calculating the expected return. Then we have calculated the abnormal return, that is actual return minus expected return. Okay, actual return minus expected return. So that will give you a good amount of, say, understanding how much abnormal return you are getting on the event, pre-event and post-event, so that you can use it for further further analyzing whether that event is impacted positively or negatively, or it has given good amount of abnormal return to the investor or not. Okay. Now we'll move to something called Hammer-French model. Okay, so you got these two models, market model and say CAPM model. Now we'll move to Hammer-French model. In the Hammer-French model, we have three factors. One factor is RM minus RF, that was there in the CAPM also. Okay. Now we are coming out with two more factors. One is SMB, small minus big. Then it is actually HML, high minus low or high minus big. Okay, small minus big and high minus big. What is this? This is the size factor. One is market return that we have considered, risk adjusted market return. Then another factor is called as size factor, that is called small minus big, based on the market capitalization. When we say size, we consider the market capitalization of that stock. Then another is book to market factor. This book to market value is the high minus low or high minus big. Now you say we create three different series. What is market capitalization? Can anyone say? What is market capitalization? Anyone?
Is it the total number of shares in the market multiplied by the price, basically the total value of the company?
Total value of the
company.
So it is just like number of outstanding shares multiplied by price of the shares. Okay. Suppose 1 crore shares are floating, or it is the free float market capitalization, price of the share. Now, if market capitalization we will consider, we can figure it out them into different buckets. One is high market capitalization, or large cap, small cap, mid cap we say. So one is high and another is low. So that is how market capitalization will come, and that will add as one of the factor. That is how Hammer-French came out with. Then one more category is book to market cap ratio, or book to market ratio. That is also another factor. So
Sir,
yeah.
Sir, sorry to interrupt, but we have a class at 11:30. Can we continue it next day?
Okay. So before coming to next class, you have some homework. Just do the event study. Please note it down. Do event study of any of the stock. Okay. First event study in Excel itself you do. Then we'll do in our next class. Second, you do CAPM model. You try with any of the stock CAPM model. And third, you do market model. So these three things you do before you come to next class. You can email to me once you have done, or accordingly we will proceed, so that you will able to see the basic part when we are moving towards the advanced part. Okay, okay. Thank you all. Who are present, just I will note it down.
So these three things we can do for any stock, right?
Any stock, yes.
Okay, sir.
And you have submitted the assignment, your periodical assignment?
So not yet. We are yet to
Sir,
submit it.
Why?
it's on 10th, right?
Yeah. Okay.
So we'll tell the CR to make a folder and she will mail you the entire folder. So that will contain all the assignments of all the students.
Okay. Saranya is present, then Rasi, then who are there? Mansimran, Gaurav, another Gaurav was there.
Sir, he left 15 minutes back.
What is his name? Gaurav?
Gaurav Datir, Datir.
So Manvi also present.
Manvi, Gaurav. Yes. Okay. Thank you all.
Thank you, sir.
Thank you, sir.